When it comes to investing your money, there are a lot of different opinions on the best way to do it. Some advocate maxing out your 401k, while others say you should hold off until you've paid off all your debts. So what is the proper order for investing your money? When it comes to investing your money, there are many options, from 401k, IRA, and HSA to student loans, mortgages, etc. In this video, we will share with you what we think is the optimal way to invest your money. Yes, every situation is different, but we believe there are some general guidelines that most people can follow to ensure they're putting their hard-earned money to work in the most optimized way possible. Number 1 on our list is an emergency fund. Before putting a dime into the stock market or anything else, you should first save up some money in a simple checking or savings account. The exact amount will be different for everyone and largely depends on your risk tolerance. The recommended amount is a minimum of 6 months' worth of expenses, but if you want to be extra cautious, 1 year's worth would be great. Let's face it, life does not always go as planned. Sometimes you need extra money to deal with certain situations. For example, if your car broke down or you lost your job for some reason, having an emergency fund lets you pay for these unplanned costs without having to change your regular budget. According to a Bankrate survey, 34% of American households experienced a major unexpected expense over the past year. However, only 39% of survey respondents said they would be able to cover a $1,000 expense using their savings. Most often, people don't have a choice but to use credit cards to cover the shortfall, which sends them into a deeper financial hole. In our journey to debt paydown, investing, and financial independence, there will always be unexpected expenses, but enough cash in our emergency fund will ensure that we don't get derailed and help us stay on track towards our financial goals. Number 2 on our list is a 401k employer match. This should be your top priority if you work for an employer that offers to match 401k contributions. Before you do anything else, take full advantage of your employer's matching contributions. 401k match gives you a guaranteed 100% return on your investment right away. Suppose your employer matches the first 5% of your retirement contributions, and you make $50,000 a year. This means the first $2,500 you invest in your 401k instantly doubles to $5,000. No investment in the world offers risk-free returns like that. If you're unsure if your company has a 401k match policy, ask your HR department or your benefits manager about it. And if it is available, make the most out of it. Number 3 on our list is getting rid of high-interest debt. We categorize high-interest debt as anything more than 5%. This would include things like credit cards or high-interest student loans for most people. Credit cards are one of the worst high-interest debts because the average credit card has a 16% interest rate. If you have credit card debt that you've been carrying month to month, this is where you should begin your debt reduction plan. There is no easy way to knock down high-interest debt except to pay it off. List out all your high-interest debts and create a plan for getting rid of them. You can use the debt snowball or avalanche method, whichever best motivates you. Once the high interest is under control, you'll be amazed at how much income you have available to optimize the rest of your finances. Once your high-interest debts are paid down, the next item on the list should be maxing out your Roth IRA. The Roth IRA is one of the most tax-efficient accounts available to investors. With a Roth IRA, contributions are made on an after-tax basis, but any growth is tax-free. Of course, there are conditions, such as needing to leave the money in your Roth IRA account for at least 5 years and having to reach the age of 59.5. However, what is amazing about the money in the Roth IRA is that you will never need to pay taxes on it. There are some eligibility considerations for a Roth IRA. To contribute directly to a Roth IRA, you or your spouse must have earned income, but not too much. In 2023, if you're married and filing jointly and your combined income exceeds $214,000, you're ineligible to make direct Roth IRA contributions. But if your income is too high to contribute directly to a Roth IRA, you could use the backdoor Roth IRA strategy. The contribution limit for anyone under 50 in 2023 is $6,500. If you're 50 or older, the contribution limit is $7,500. Number 5 on our list is taking advantage of a health savings account, also known as an HSA. Now, this may not be for everyone. You need to be eligible to contribute to an HSA. Before you can put money into an HSA, you must be covered under a qualified high-deductible health plan, HDHP. However, this is a great way to save money for future health-related expenses if you qualify. HSAs offer what's known as the triple tax benefit. Your contributions are tax-deductible, and your money grows tax-deferred. You can withdraw money from your HSA tax-free as long as it's used to pay for qualified medical expenses. If you're qualified for a high-deductible health plan and you get an individual plan, you can contribute up to $3,815 in 2023. On the other hand, if you get a family health insurance plan, you can contribute up to $7,715. If you are 55 or older, you can contribute an additional $1,000. Number 6 brings us back to the 401k, but this time not just for the match, but to completely max it out. Just because you've taken full advantage of your employer match, doesn't mean you can't contribute more money to your 401k. This is one of the most effective ways to lower our taxable income and put more money into the market. The contribution limit for anyone under 50 in 2023 is $22,500. If you're 50 or older, the contribution limit is $30,000. Number 7 on our list is the taxable account. Once you've maxed out all your tax advantage options, you can start investing additional money into a regular taxable investment account. Many people often open up taxable brokerage accounts way before they've maxed out all their tax advantaged accounts. But this should be your last priority since you don't get any tax advantages. When tax advantaged accounts like a 401k aren't used, and instead, taxable accounts are used, the tax drag can be significant, especially when added up over many years. Tax advantages like tax deductions allow more of your money to work for you in the market, resulting in greater growth in the long run. Why pay more in taxes than you need to? Number 8 on our list is where you can tackle lower interest debt, which means debts with interest rates lower than 5%. This often includes low-rate student loans and most car loans, but not most mortgages. Even though, from a financial perspective, this debt may not be hurting you as much, you should still get rid of it if you have the means to do so. You should never let your guard down around debt because it has a way of quickly warping your perception of money. Accepting debt as a normal part of life can lead to justifications that are close to being dangerous. You can start to fund an elevated lifestyle with that low-interest debt, by buying cars you don't need or spending on other unnecessary expenses. By getting rid of as much debt as possible, you're not only taking care of your financial well-being but also your mental and emotional well-being. Number 9 on our list is optional, but a valid way to deploy your money if you choose to do so, and that is to pay off your mortgage. If you purchased a home in the last few years, you hopefully benefited from a low-interest rate environment, and you have at least a decade before your loan matures with a 15 to 30-year time frame. The chances of the stock market outperforming your 2 to 4% mortgage are very high, so it makes sense to invest your extra cash into index funds rather than the mortgage. However, this is an excellent option if you're getting to the end of your mortgage and want to be completely debt-free. There is nothing better than living in a mortgage-free home. Ultimately, as long as you're investing your money with some common sense, your net worth will skyrocket, and you can rest easy knowing you're taking smart steps to drastically improve your finances. Also, if you have not already done so, please like, subscribe, and share this video with your friends. We'll see you in the next episode.